I'd like to welcome you to tonight's event, Another Housing Bubble, Forecast Risks, Policies, and Management. Throughout the event, you may post any questions you have using the Q&A feature at the bottom of the screen. Questions will be answered at the end of the event. Here are some upcoming ERM events you may be interested in. Our Exploring the Power of Mindfulness workshops continue throughout October. All of our ERM seminars are on Fridays and Saturdays through the end of the semester. On October 29th, we have a book launch event with Cruz Juiciotis, author of the Credit Analyst Survival Manual. And on November 13th, we have a new event, Third-Party Risk Management and AI. Information on all these events is on the ERM website on the events link. And now I'd like to introduce tonight's moderator, Bruce Fox. Bruce?
Thank you, Jay, and welcome everybody to this interesting event. I'm very excited. It's been quite a while in the planning. So the question here is, are we in a housing bubble? And if so, how bad and with what consequences? Home prices are up 9% per year over the past 5 years, which is roughly double what they have been up per year since the start of the Case-Shiller Index. So quite an increase over the past 5 years. Fannie Mae reports that housing sentiment is the highest level it's been in over 2 years. Prices seem high compared to rents and compared to income. And in fact, the National Association of Realtors Affordability Index is at an all-time low. This raises certain questions. Are we in a housing bubble? If so, what are the consequences if it burst? What financial institutions or investors are exposed if we are in a bubble and prices fall? And how can participants manage their exposure to the housing market? We will explore these questions and others with a panel of experts who I'll introduce now. First off, Christian Doritas, who's the Deputy Chief Economist at Moody's Analytics. Secondly, Lori Goodman, who's an Institute Fellow at the Urban Institute. And then Pratik Gupta, who's head of RMBS and CLO research at Bank of America, one of the top market makers in this area. And finally, Dan Thacker, co-chief investment officer at Chimera Investments, and I might add, an old friend of mine. So I'm very excited to have all our panelists do this with us. And I think I'd like to start off, first of all, to ask each of the panelists to further introduce themselves. What is it that they do now? And how did they develop their expertise in housing? Christian, can you start us off?
Happy to. Thank you, Bruce, and welcome everyone. Thank you so much for the opportunity to be here. So I am Chris Doritas. I'm the Deputy Chief Economist at Moody's Analytics, so a division of the broader Moody's Corporation. You may know the rating agency. My day job involves forecasting, right? A lot of forecasting of a wide variety of U.S. and subnational variables, indicators. We also forecast countries around the globe. I head up our housing team. So I am in charge of all of our housing-related forecasts, prices, sales, construction, et cetera. And in addition to that, I serve as a little bit of a liaison to our banking clients in terms of how the forecast may actually be used to price mortgages or to forecast credit risk. And the reason why I do that is because prior to joining Moody's, I was with Fannie Mae for a number of years. So I have some experience modeling mortgage risk, prepayments, defaults, loss severities and whatnot. So that's my story. I'm very happy to be here and look forward to the discussion.
Thanks very much. Lori, can you take it away?
Sure. Well, thank you very much for having me on. I'm Lori Goodman. I'm an Institute Fellow at the Housing Finance Policy Center at the Urban Institute. Urban Institute is a think tank that houses about 10 different policy centers, everything from justice policy to health policy to housing finance. I started the Housing Finance Policy Center in 2013 after almost 30 years as a Wall Street mortgage-backed securities analyst and manager of fixed income research departments. I had a front row seat to the great financial crisis as I was heading UBS's securitized products research group at the time. We were negative about the prospects for the market, but in retrospect, not nearly negative enough. After UBS, I went to Amherst Securities during the sort of depression in 2008. I noticed that did a lot of, and public policy was very important for securities valuation, did a lot of public policy work and basically fell in love with it. I noticed on Wall Street, we had a lot of money to buy data and the resources to harness that data. During the crisis, I was giving out a lot of data to government agencies, to nonprofit groups, and I realized that others didn't have the same data capacity. I also realized at that point that too many decisions on Wall Street were made on ideological grounds without regard to the data, and there was no trusted source to the data. I took this void in the market, plus the fact that I was too tired of doing what I was doing and too young to retire, as an opportunity to found the Housing Finance Policy Center at Urban, doing data-driven analysis of public policy issues. After running the center at Urban for 8 years, I handed the reins off and returned to focusing exclusively on my first love, which was research.
Thank you very much, Lori. Fantastic. Pratik?
Hey, good afternoon, good evening, and thank you for having me. Thank you for joining this event. I'm a research analyst, just like what Laurie said. I love doing research. I currently am the head of RMBS and CLO research here at Bank of America, covering the US housing market, the related securities which come off it. If you hear the word subprime, option arm, Alt-A, that is exactly what I cover. I cover also the product called CLOs. Essentially anything which went bad in 2007 is what I cover in the post-crisis era. And I may not have the ringside view, but I look at the data, I look at the historical trends. And the one thing which I tell myself is that I don't want to make the same mistake, is that if I see a bubble, I want to call it early and not be telling investors, buy this bond, when in hindsight, those bonds took so many losses, right? So this is my day-to-day job. I'm very fearful of making that mistake, which some other researchers made, not Laurie, but some other researchers made. So that's my day-to-day job today. Look at the housing market, look at credit trends, look at losses, and excited to share about my findings with you all.
Thank you very much, Pratik. And finally, Dan?
Hi, Bruce. This is Dan Tacker. Just want to make sure I have my video. Right, so I am the Chief Investment Officer of Chimera Investments. I've been here for 4 years, 2 years as Chief Risk Officer and 2 years as Chief Investment Officer. What is Chimera Investments? We are a mortgage REIT. A lot of folks in the audience might not be aware of that. That essentially buys loans and securitizes them. We are a niche player in something called the RPLs. These are the reperforming loans. Basically, these loans went delinquent during the Great Financial Crisis. And have cured since then as the economy has improved or these borrowers have regained their jobs, built up equity as home prices have gone up. So that's what Chimera Investment does. Before that, I was at Genvert, heading up fixed income public trading desk. As Bruce mentioned, we worked there together for a while. Before Genvert, I was at a place called Hyperion. That firm was actually founded by Lou Ranieri, who was known as the father of residential mortgage-backed securities. And finally, I started my career at MetLife, where I spent 9 years, had stints in portfolio as well as risk management. My last job there when I left was trading agencies as well as non-agency mortgage-backed securities. Thanks.
Thank you, Dan. I should have mentioned that in the financial crisis, I was a managing director in risk management at Citi. So I think between all of us panelists and your moderator, we bear the scars of the financial crisis and what it did to the housing market. So quite a group of experts. So thanks for that introduction. So my first question, and I'll put this to Chris first, is what is your forecast for home prices over the coming years, and what drives your forecasts, and what do you think the risks to your forecasts are?
This is a great question, one that I receive in forums such as this and at cocktail parties. So it's very relevant for everyone. My forecast at this point calls for a relatively slow but positive growth in house prices nationally. Right, we have seen this very sharp increase in growth that Bruce alluded to, about 50% increase in house prices since 2020. So that's remarkable. That's certainly much faster than we've expected historically or seen historically. At this point, we do have a very serious affordability challenge, and I believe that will continue to weigh on the housing market. Although I do expect to see mortgage rates coming in, something closer to 5.75%, maybe 6% over the next year or two. That's a very modest reduction in mortgage rates. And while it's helpful in terms of making housing a bit more affordable for buyers, particularly first-time home buyers, it's still quite a challenge. I expect that we will see more supply coming online over this time period as well. That's going to put some downward pressure on prices. Again, I'm not calling for any type of correction here, but that additional supply in terms of new construction, new apartment buildings, new single-family homes coming online, that is going to help to put some of that more downward pressure on prices going forward. We should also see more existing homes coming online as well. I think we'll get into, of course, the so-called lock-in effect, with many homeowners locked in to mortgages that carry very low interest rates, a 3-4% mortgage rate, and thereby are reluctant to actually sell their homes. But as time goes on, life will happen, and we will have more life events driving homeowners to go ahead and list their homes, perhaps downsize, move around the country, if you will. And that additional inventory should also help to lead us to a bit more of a sustainable housing market. So low growth, relatively flat, I would say, compared to where we've been. And then eventually we'll get back to more of a normalized growth rate of around 4 to 5%, as Bruce mentioned, as some of these factors work themselves out.
Chris, could you talk a little bit about the risks to your forecasts? And if things go bad, how bad do they get?
Yeah, I would actually put the risks to, well, it depends on which side of the coin you are when you say downside or upside. But I would say that the risk at this point is actually that the house prices remain more robust than what I've suggested. The supply is extremely tight still, although there is more supply coming online. We are still well below what would be considered a normal housing market. And certainly I could create a scenario where that lack of supply continues to meet up against rising demand or strong demand, and that continues to push prices upward. So that's perhaps a positive for the existing homeowner, but certainly a real challenge for anyone who's trying to break into that housing market and purchase their first home.
I like the way you answered my question. You answered there's risk to the upside too. I was thinking about downside in asking that question, but that was a good answer.
Yeah, it's all perspective.
Okay. Yeah. Pratik, how about you? What's your forecast and the rest of your forecast, either down or upside?
Sure, no, thank you. And I think Chris covered it very well. To add to his point, I would certainly say that our near-term forecast is about 3.5 to 4% growth in the home price index for the next 12 months. I think 2025 could be very interesting. We do see existing home sale for inventory actually increasing. So that is existing homes being listed at a greater pace versus what we have been having. So that is going to have some downside pressure on home price growth. Now, it's not going to be very negative, but I think the significant growth, for example, the plus 9%, which Bruce, you highlighted, is certainly going to come under pressure going forward. So I think we are probably in the realm of roughly 3 to 4% context growth rate over the next couple of years if this supply pressure continues to go up. And where is the risk factor, right? I think the risk factor is around climate costs. I think we've had 2 hurricanes which have occurred in the past month, tragic events. Unfortunately, 2 of them hit Florida with very close proximity to each other. Before the hurricanes hit, we already saw existing home sales increasing in certain areas in Florida, like Tampa, for example. And that had already reached pre-pandemic levels. So if you look at the nationwide inventory for sale, we are still, I think, very, very much down from where it was in 2019. But in certain MSAs like Tampa, in certain MSAs like Denver, Phoenix, they're already approaching pre-pandemic levels. And this is at a time when mortgage rates are very high, affordability levels are at near-time lows. And at the same time, what we think insurance costs are starting to have a bigger impact on consumer wallets, especially in areas like Florida, where hurricanes occur with greater certainty. So I would say, in my view, the near-time risks to the downside are in climate risk associated areas. That is where I see home prices to see some downward pressure, not as much as a 20% downward pressure we saw during the great financial crisis, but certainly a bit more. I don't think there'll be a significant positive event as well. So that is my risk here.
Very interesting. So more of a regional story in terms of downside as opposed to a national one.
That is right.
Yeah, very, very interesting. Okay, thanks. Dan Thacker, how about you?
Yeah, I would say that, 2024 finishes in terms of home price appreciation up in the low single digits. Just looking at the Case-Shiller index, year-over-year home price growth, has continued to slow for the fifth consecutive month from 5.5% to slightly below 5% currently. The one reason for that is, inventories, while low by historical standards, they have continued to grow. They're the highest since 2021. Just to talk a little bit about the lock-in effect, which, folks talk about it all the time. Currently, like 65% of the borrowers have a mortgage rate of, 4% or lower. And given where the current mortgage rates are, I think this morning they were close to 6.5%. These borrowers are locked in, and we would need to see a meaningful rally in mortgage rates, for significant inventory to come back to the market. And I believe if that were to happen, so the demand should pick up there too. So they can fall on the margin or up slightly, as I said. So people need to be forced sellers to drive prices significantly lower. And that is basically the rationale, as far as my forecast for a slower appreciation in prices or very marginal declines.
Thank you, Dan. And finally, Lori.
Yes, thank you very much for the question. So I'm sort of in the 2 to 3% going forward, sort of very close to where Chris is. The major reason that I'm positive is that we have an acute lack of supply. We built way too much going into the financial crisis, and then the market crashed, but we've been underbuilding ever since, even as home prices recovered. So we're somewhere between 1.7 and 5.5 million units short of demand. Looked at differently, from 1958 to 2008, we averaged about 7.7 units of new construction per thousand population. That is single family plus multifamily plus manufactured housing shipped. It went way down after the crisis, and it's recovered. But for 2023, it was 5.1 units per thousand population. So even though supply is up relative to where it's historically, relative to sort of recent history, that is post-financial crisis, it's really low in a historical context. And I would argue that this drives up both home prices and rents. And moreover, there's like no single cure for this. You've got zoning issues, regulation, costs of materials and labor, and financing issues. So there's no single cure. I do want to sort of make 2 points. One is, I am not totally convinced that affordability has a big effect on home prices at all. In fact, people tend to think, oh, high interest rates, low affordability, therefore lower home prices. In fact, when you look at that relationship historically, what you find is that the relationship between rates and home prices is actually slightly positive, very slightly. Statistically almost insignificant. That is, higher rates are associated with higher home prices because they're associated with a strong economy and higher inflation, and that outweighs the affordability concerns. So historically, that relationship is actually very weak, and if anything, goes the wrong direction. The only time you've actually had negative home price, when you've actually had home price declines, is during recessionary periods. In terms of the risk to my forecast, I actually think the risk to my forecast is that home price appreciation is stronger than I think it will be, just because of the supply shortage. Although, as Patrick mentioned, it's actually a regional story, and not all areas are going to fare equally well.
Very, very interesting answer. So it does seem like most of you think that moderate positive increases with could be the big risk on the upside in interest of prices more than on the downside, except for certain regional stories, particularly those that could be impacted by climate. So very, very interesting answer. Thank you all. Okay, so next question, and maybe we'll go back to Chris to start this one, is what has changed since the great financial crisis to increase resiliency? It sounds like all of you think that things are resilient. Maybe part of that is population and underbuilding, but is there anything else that you want to talk about?
Yeah, so I'd give the two reasons. One is the demographics, right? Our demographic picture is completely different, 180 degrees from where we were during the Great Recession, or the lead up to the Great Recession. Back then, we were building too many homes relative to the household formations, right? That was the Gen X or the smaller generation coming of age during that time, and the home building was very strong. So you did have that somewhat of an imbalance in terms of too much building relative to population. And then, as Laurie already alluded to, after the Great Recession, we pulled way back on construction, and we've seen a very limited type of recovery here. But the demographics are now in the opposite direction because of the millennials. So we have a lot of young adults, a lot of people who are looking for homes, a lot of renters would love to be homeowners, right? Providing a very strong foundation, if you will, underneath the market. The one statistic I'll throw out here is we have about 7.2 million 18 or 25 to 34-year-olds living at home with their parents. It's a very large population. In percentage terms, about 50% more than what we had at the turn of the century. So, that dynamic is completely reversed. The other key difference today, of course, is the lending standards, right? All of the interesting or creative financing that Pratik reference in terms of the option arms and NAGAM loans, the Nina loans, the Ninja loans. Some of you will know what I'm talking about here, but there's all sorts of very loose underwriting practices that went on during that Great Recession period. Those have been eliminated. We are not originating those types of loans to any significant degree. And the loans we are originating or have been originating throughout this entire period have been highly qualified, high credit scores, relatively low loan to value ratios, although we can certainly talk about perhaps some emerging risk in some pockets there. And I would certainly identify perhaps debt to income ratios as rising, but still relatively low compared to where they were back during that Great Recession period. So there are some pockets of risk. I don't want to say there are nothing to worry about here, but it's a very different environment today, and I think that supports the price forecast that we've given.
Okay, thanks very much, Chris. I want to just mix up the order a little bit. Laurie, do you want to talk to this question?
Yes, this is actually one of my favorite questions, so thank you. So I agree with everything Chris said in terms of the tightening of lending standards. They were way too loose going into the financial crisis. Now, arguably, they're too tight. And I'd like to actually talk about so things like income doesn't mean the same thing it used to. It used to be that you provided 2 pay stubs and you were done. Now you have to verify every shred of income. And if you don't have 2 years of income in the same job or a job in the same field, you have trouble counting it. It's hard to get gig income counted toward mortgages. So, everything has tightened up. In addition, the importance of the tightening of lending standards goes beyond the tightening of lending standards. It also increases resiliency because you've cut contagion. If you sort of think back to the great financial crisis, you had home price appreciation, which meant low delinquencies. Low delinquencies meant looser lending standards. Looser lending standards meant higher home price appreciation. And you were in this sort of incredibly positive feedback loop. And then when the shit hit the fan, so to speak, it reversed. That is, you had delinquencies beginning to pile up, which meant home price depreciation, which meant tighter lending standards, which meant higher delinquencies, more home price depreciation. You were in and sort of delinquencies, and the home price declines fed the bust in home prices. So you sort of cut out that negative feedback loop by eliminating these risky products. The market actually eliminated them well before the Dodd-Frank rules came into effect, well before the qualified mortgage rules came into effect. And it wasn't just the lending standards. You've also increased the capital requirements on financial institutions. The leverage for financial instruments is now a lot lower than it used to be. So you've cut that negative feedback on the financial side as well. Some of the products like collateralized debt obligations, where you essentially levered up portfolios of triple B subprime credits, have been all but removed from the market. The structures that you have left in the mortgage market are much, much simpler. But I think sort of the tighter lending standards sort of leading to the elimination of the negative feedback loop is just a really critical link.
Very interesting. It sounds like you've been through every single version of different loans over the years. A very detailed answer. So thank you. Pratik, any thoughts on that? Why are we more resilient, and if so, why?
Sure. I think Christian and Laurie covered it all, but for the audience, and most of you are students who probably were still in maybe kindergarten or elementary when this happened. If you look at the non-agency market, which is what I think when people refer to the risky mortgage product sector, that was back in 2005 to 2007, the non-agency market used to be comprised of subprime loans, option arm loans, where your balance would increase because you're paying a very low interest rate. These products are basically have almost all but disappeared from the lending guidelines, as what Chris and Laurie said. And this is because of the evolution of the Dodd-Frank Act. It has imposed significant constraints and regulations on mortgage originators and servicers as to what kind of products they can originate. The qualified mortgage rule came into effect, and that has placed even greater standards on the income documentation, which Laurie highlighted. I think one big change, though, has been on the servicing side. So in the mortgage landscape, you have mortgage servicers whose responsibility is to collect monthly payments from the mortgage borrowers and transfer them to the mortgage owner. So mortgage owners are basically banks. You're talking about Fannie Mae, Freddie Mac, Ginnie Mae. So these are the entities which hold the mortgage products. The servicer is responsible for passing along this payment. The servicer is also responsible for connecting with the borrower if the borrower has some kind of payment in default effect, and essentially resolving through this particular default event through modifications. What has changed through the great financial crisis is that in the GFC era, you could see servicers foreclosing on borrowers on a very proactive basis, right? Foreclosure rates increased pretty significantly during the GFC era. I think that has changed. In today's time and era, if you are faced with a credit event, when I say credit event, I mean it's a job loss, medical issue, COVID forbearance, hurricanes, which causes you to miss your mortgage payments, the servicer will work with you, where first of all, you're offered a 12-month holiday plan. We're saying, okay, as you resolve this issue, let's offer you a 12-month payment holiday plan. And let us work through your mortgage problems. Let us offer you solutions which can reduce your mortgage debt if you cannot make your current mortgage payment. And I think the solutions era-based time which we live in means foreclosures are a lot less in frequency. And that has an impact of reducing supply during times of distress events like recessions, for example, which Laurie was highlighting. So one thing which I do think which will make it more resilient is that if you do see a recession going forward, I think the presence of these modification programs means foreclosures will be a lot lower than what you have experienced earlier. And that will make the mortgage product a lot more resilient, especially from significant declines in home prices.
Very interesting. Thank you. Dan Thacker, are we more resilient? And if so, why?
Yeah, Laurie, Chris, and Pratik covered this pretty well. And I don't have too much to add on what they said, but I'll say that is one of the sources of the leverage, back in the crisis and before was the proliferation of the CDOs, synthetic CDOs, not to mention the single name pay-as-you-go CDS. Those markets don't really exist today. The data is sort of difficult to pull accurately, but we know that pre-GFC, activity included piggy bank seconds that commonly took, CLTVs north of 90%, if not all the way to 100%. While second liens are slowly becoming more popular today, the data that we are seeing so far leave CLTVs, well below 80%. So, I'm just going to say that the system has a lot less leverage than it did during the great financial crisis. Product like ABS CDO, CDO squared, synthetic CDOs, they produced a leverage on leverage situation that just doesn't simply exist this time around.
Prior to the financial crisis, I think you could have made the argument that home prices were very high relative to rents and also high relative to incomes. And that might have been a warning sign of trouble to come. When I look at it, it seems like we're again in a position where home prices look elevated relative to both rents and income. Do you agree with me? And if so, is that not a warning sign this time around? Maybe we'll go to Chris on that one.
Sure. So, well, first, yes, I agree. I mean, the facts are the facts, right? We can look at price to rent, price to income ratios, and they are elevated relative to history. They are certain. I think price to income. I guess one thing to kind of stress throughout this discussion is that you want to be careful with a lot of different data sets, right? We talked about house prices, but there are lots of different house price indices, house price measures out there. So we're talking kind of broad generalities, but specifics are going to differ from index to index. But price to income ratio, kind of looking at median price and median income, is right around 5 times, right? That is elevated compared to history. It's kind of close to where it was during the peak of the housing boom, certainly much higher than it was prior to the pandemic back in 2019. So from that perspective, very elevated. And price to rent also about 25 times, right? Price is about 25 times the annual rent, median annual rental payment. And that was closer to maybe 20 times, but that might be more of an equilibrium. So from those perspectives, we are high. Although I would make a caveat that, and again, I guess this goes to what's different this time. I do believe there have been structural shifts in the economy as a result of the pandemic, right? We have more people certainly working remotely. We have households that value their housing much more, right? Because they may be working at home, so they need the more space, or for a variety of reasons, they are certainly investing more in their home. So there's some justification for a somewhat higher price to income or price to rent ratio, but nonetheless, I still see us as being high relative to what I would consider more of an equilibrium. And then the question is, how do we get back to an equilibrium? Well, that goes to my kind of flattish, low growth type of a story here, versus the more acute type of decline that we experienced during the housing boom and bust, when prices simply fall all the way back down, or maybe even going below equilibrium, only to climb back up. So yes, I would agree with you. I think that based on every metric of equilibrium that we have, we are disjointed here. We certainly have gotten ahead of our skis in terms of prices, and that would argue for some type of an adjustment, whether it's gradual or more severe.
Okay, thanks, Chris. Maybe we'll go to Dan Thacker next on this. Dan is the person on the panel who actually invests in housing assets, so could feel the impact if these ratios, prices to rents, prices to income, were to right size. Dan, are you worried about these things?
Yeah, I certainly am, and I can, give an answer, in terms of like how we manage the housing risk. It's a little more about like how Chimera, as an asset manager who specializes in RPLs, we do that. I sort of do agree with, Chris, pricing to the rent ratio, especially in some metros, which benefited from, the remote areas. And as Pratik alluded to, we are seeing, the areas, some metro areas, especially in Florida, where inventories are up by like 60% in Tampa and Sarasota. So we definitely, I don't do this for a living, but we are very cognizant of that. But in terms of like how we manage the risk is, we have a portfolio of loans that, has LTVs in the mid 40s. As I mentioned before, these are reperforming loans. They have been seasoned and, burnt out for the last 15 years or so. So that's a lot of equity cushion built in, if we were to ever face a severe default cycle. So like, that's how we sort of manage our risk on our portfolio. But I do agree that there are prices, as you compare to the rents, they have sort of gone up, and there is a correction bound to happen in those areas, although not as big as something we saw in great financial crisis, but I could definitely see prices correcting 5 to 10%.
Lori, what about you? Do these ratios concern you?
So I do think so. Home prices are definitely elevated relative to both rents and to incomes. It's important to realize that most people don't pay that marginal home price. They're locked into their home. And in fact, they use the pandemic to refinance. So they're sitting really, really nicely. So it's really the marginal buyer that's affected. I'm where Chris is, that the pandemic basically caused changes in habits. People are willing to spend more on housing than they used to be. And in terms of housing relative to rents, I think, the pandemic also gave people this urge for stability. And when you buy, you have a place to live that's your own. When you look at median home prices versus median rents, what you're actually missing is that rents have gone up a lot more on single family homes than they have on apartments. So when you're doing a more apples to apples comparison, yes, home prices have way outstripped rents, but that differential is not as much as it first appears looking at median to median. So the fact still holds, but the order of magnitude is slightly less. The recent bout of inflation, even though it's largely over, I think that emphasized to people the fact that when you buy, you lock the single largest component of your monthly payment, which is your mortgage. And that amount can only go down if interest rates go down and you're able to refinance, whereas rents go up. And I think that there's this lingering fear among a lot of people that inflation, yeah, it's down for the time being, but it certainly has reared its ugly head and it's not dead. So the answer is yes, but again, we're a little bit outside of equilibrium, but not as much as it looks like. I agree with Chris that it corrects by home prices going up more slowly than perhaps rents go up for a number of years.
Thank you, Lori. And finally, Pratik, what about it? Do these ratios concern you?
Not at the moment. And the simple reason is that Lori talked about the housing shortage. And that means if you look at the existing home sales for inventory right now in the US, it's close to 1.3 million units, right? If you look at the renters population right now, and I think there are currently 9 million tenants in the US whose median income is more than $80,000, that cohort can potentially withstand the high mortgage rate environment and is still affordable for them to bid on these 1.3 million properties for sale. So if I look at the housing market, right, the median to median number is not right, because what drives home prices is the sale price on these inventories for sale, and that is basically being driven by the upper end of the tenants or the upper end of the housing market, which is looking to move from their current home to a new home. So it's already a stratification of the upper end of the median priced income segment or the median price home segment, you call it what. And that means that is why the median to median ratios may not matter as much as looking at the quality of the properties and the quality of the tenants bidding on these properties. So as of the moment, I think as long as inventory remains tight because of this housing shortage, I think the ratios in itself don't really matter as much to me. But as inventory picks up, these ratios will start having a bigger and bigger factor in home price growth going forward.
Okay, thanks everyone. Great answers. So here's a question. What if your relative optimism, what if you're all wrong and home prices fall 20%? Now, in the financial crisis, Fannie and Freddie went under and had to be effectively bailed out by the government, effectively taken over. Yes, they still have shares that trade freely in the market, but they're wards of the state. Are they exposed now the way they once were? And if the answer is no, where does the risk lie? Who gets hurt if home prices fall 20%? Well, why don't we go to Chris on that one, given that he worked at Fannie Mae?
Okay, sure. So great question, right? Things have changed structurally in the mortgage market as well, not just all the housing demographics and whatnot that we talked about. So I guess the first thing to note, of course, is that there is a lot of equity in homes, right? So a 20% house price decline perhaps doesn't mean as much as it might have in the past, right? It's not nearly as catastrophic given this 50% rise in home prices since the end of 2019. So first and foremost, right, you would certainly have a lot of homeowners who are, would be distraught that they're losing on paper some of their gains. But in terms of whether or not that causes them to go into a negative equity position, it's certainly a much lower percentage than it would have been in the run up to the Great Recession. So that's one. But the homeowner, of course, is in the first position, right? They are the most exposed. Some homeowners in that 20% with a 20% house price decline would be affected, certainly. And certainly that 20% house price decline is presumably accompanied by a very weak economy. That's the only way I can think of a reason for prices to really crumble like that, is that we have a very high unemployment rate, just a lot of stress economy-wide. It's going to be a regional impact as well. You kind of alluded to that. So we do know that there are certain markets that have gotten way ahead of themselves. So nation is one thing, but then there are markets like in Austin or a Dallas or a Boise or Phoenix, right? Some of these markets that really have seen a high appreciation over the last couple of years, they could be certainly exposed to even larger price declines in this particular scenario. In terms of then, what does that mean for Fannie and Freddie? Well, they are, for one thing, their G fees are much more in line with risk-based pricing. So what they charge in order to cover credit risk is much more aligned with what the actual risk is. They're pricing at least to higher capital standards. Right, so that's one. They have less exposure from that standpoint. Another great innovation has been the risk transfer facilities that they have engaged in as well. So this was perhaps silver lining of the financial crisis, is that these financial transfer facilities that had kind of been on the shelf for a while really started to gain some momentum. And so now both Fannie and Freddie sell off some of the credit risk effectively to outside investors. That protects their balance sheets, but ultimately protects the taxpayers to some extent. And so those investors potentially would be facing some credit losses under those facilities. Right, so that I see as a kind of one of the bag holders, if you will. The nice, or the beneficial part of that system is that risk is now diversified across the population. So there are plenty of investors in these risk transfer facilities, either directly or indirectly, and so it's not as concentrated a risk as it was previously. So you do have insurance companies, pension funds, other institutional investors who may take a piece or invest in these risk transfer facilities that are exposed to some of the credit risk, but the likelihood that 20% down scenario that you described would take any one of them out is relatively low. So we've done a good job of distributing that risk around the population. Of course, mortgage insurers are in line as well. They certainly would face some losses in this particular scenario, but those businesses, as we know, are managed to very high standards, lots of regulators looking over the shoulders there. And so I don't expect to see that I would expect to see these institutions being able to withstand this type of a scenario, withstand taking some losses without incurring a solvency issue. And I'll pause there.
That's a great answer. Thank you. And maybe we'll go to Lori next. Lori, I remember you and I spoke about this very question. How much risk does Fannie and Freddie take right now? And is there a possibility we're lulling ourselves to sleep? Yes, all the risk transfer that Chris just talked to, but what if it doesn't work? Or what if those people that are basically taking on the risk can't survive a 20% downside? In general, where does the risk lie right now?
So, I mean, just to pick up Chris's point, the risk actually lies with the borrower. I mean, the amount of homeowners' equity in the system has increased so substantially relative to 2006. Just to give you some very quick numbers, in 2006, there was $10 trillion of mortgage debt. The total value of the mortgage market was 25 trillion. Now, I'm sorry, now mortgage debt is 13 trillion and the value of the market is 48 trillion. So mortgage debt's gone up by 30%. The value of the market has doubled. So the homeowner is very, very, very exposed. A lot of Fannie and Freddie's mortgages are very low loan to value. ratio mortgages on which they have very, very, very little risk. They also used to have very little capital to support their mortgages. Now they are building capital relatively quickly. They used to have a very large portfolio. At the peak, the portfolio of the two GSEs was close to 1.5 trillion. Now it's on the order of 200 billion. And that portfolio included many subprime mortgages, which was the first thing that went. So, as Chris said, they're now pricing appropriately. Their loan to value ratios are a lot lower. They're doing credit risk transfer. They don't have the huge portfolio that they used to have. And to pick up Pratik's point on loss mitigation, this has become very, very powerful. If you sort of think of mortgage losses as being this multiplication of three parts: the rate at which a borrower goes serious delinquency to foreclosure, and then the loss severity if you have foreclosure. That middle piece, we've done some estimates that show you've cut the middle piece, that is the transition rate from serious delinquency to foreclosure, by about 46% because of improved loss mitigation. The standardization of the loss mitigation waterfall, and then the sort of after you get through forbearance, you then have a variety of exit strategies. So that standardization has really made a very, very large difference. So I would argue that the borrower owns most of the risk. I don't think Fannie and Freddie, I would argue their risk is an order of magnitude lower. The one thing that has actually changed substantially is the bank portfolios are roughly the same size as they were before the financial crisis. The private label market is much, much smaller, really tiny, but the Ginnie Mae market is much larger. This is where the highest LTV mortgages exist. And I would argue that, that they would the Ginnie Mae market, and in particular, FHA and VA as the guarantors would feel the impact of it. So I would argue the borrower is exposed, and to some extent the government is exposed. But again, I don't think a 20% home price decline can happen because of the reasons we've already discussed.
Thank you very much. Okay, so Pratik or Dan Thacker, do you want to take on that question? Any different opinions?
Yeah, I don't have too many different opinions versus what Chris and Lori described. And the other thing, just being on the other side, I would add to that. We talked about the GSEs, and they're much better capitalized, and they have the PAs available, and do not own any non-agent securities. And the CRT market, you can't get a lot of leverage too on these products. Us being a levered player, so you go back, right, and whatever the sort of these mortgage affordability products, you could lever them like 18, 19 times, right, with a 5% haircut. Now, if you want to lever, some of these products, especially things like CRT, which are very, very thin slice, don't want to get too technical, you can't get a lot of leverage from the street. So I just want to point that out. So yeah, the risk is, as we talked about it, the participants in the CRT market, it's concentrated in hedge funds, money managers, and reinsurers. But, unless and until these guys have a very meaningfully concentrated positions, a severe decline in houses doesn't necessarily wipe them out. That's what I would say.
Thank you, Dan. Pratik, any thoughts on this one?
Yeah, I think just for the audience's benefit, I think just putting some numbers into context, I think Laurie already highlighted this, and that's a great thing. There are 135 million units in the house in the US, right? 40% of those homes don't have a mortgage, first of all. So that's all equity. So to echo Chris's and Laurie's point, if there's a decline of 20%, the folks who don't have a mortgage will be taking that hit directly. But are they levered to that? Not really. It's a paper loss, doesn't really affect them financially. The second part is, if you deconstruct the housing market further, right, 65% of those are owned, and so they live in those homes. The rest of those, right, roughly 45 million of those properties are rented out. And within those rented population of properties, the vast majority of them are either multifamily constructions or essentially single family constructions, but owned by a mom and pop landlord, really. Those folks, again, own their homes outright. They rent them out. So if they will take a hit on the rentals, where the rent prices will likely also come down in that process. But Does it mean that the GSEs take a hit? Probably not. So the housing market itself has delevered quite a bit. As Laurie highlighted, you're talking about $13 trillion of mortgage debt backed by $48 trillion of a total housing market. Your homeowner's equity is $36 trillion. It's very much delevered. So somebody's taking a paper money hit where your paper money, the paper valuation of your property goes down. So that's really it. But are you levered to that? Not really. So very few entities will take a loss, if at all any.
Very interesting. Okay, thank you all. I'm going to take a couple of questions that are online before we run out of time. I have some other questions I can ask, but I want to make sure that we get these questions in. So here's one which I think is interesting, and maybe Pratik will go back to you on this. What is the impact of institutional investors entering the housing market?
Sure. I think both Laurie and I can answer this question. We were on a panel together on single family rentals and what impact institutions have had. So let's go back to the figures we just quoted, right? So there are 46 million rental units in the US, right? As I said, a third is divided equally across single family homes, which are basically what we're going to talk about in the institutional investor space. A third is 10 plus unit apartments. So these are like multi-family constructions, all devoted to rental units. And the other third is roughly the 2 to 9 unit apartments. Now, the vast majority of the single family homes are owned by mom and pop landlords. I would say 97% of these homes are owned by mom and pop landlords. Just 3% of this population is owned by institutional investors. So as a percentage of the housing market, let's take a step back. As a percentage of the housing market, institutional investors own less than 50 basis points of the housing market. Like that's basically talking about maybe 500,000 units out of 135 million housing units in the US. So as a percentage, they have a very small ownership stake. And I don't think they have a big impact on the housing market. Where they did have an impact though, is during the great financial crisis when we had all these distressed supply coming to the market. Institutional investors with large pockets managed to buy many of these properties. I think they do still have an outsized presence in certain areas. Let's say you're talking about Atlanta. In that particular area, 5% of the housing stock is potentially owned by institutional investors. It's a large percentage, but still small, relatively speaking. As a percentage of inventory, which is out online, I think institutional investors don't bid more than 3% to 4% of the units which are online. So as such, I think there's a lot of press dedicated to this asset class from the institutional investor standpoint. Do they have a big impact? I don't think so. I actually feel they make the housing market healthier because that's a large pool of private capital backing what is essentially needing a lot of capital to rehabilitate these properties. I don't think an individual person can actually have that capital to do that. They provide that capital. So it actually makes the housing market healthier in my view. So I'll stop at that.
Very good. Any other panelists want to address that question?
Let me just chime in with a couple of additional factoids. I mean, yes, institutional investors are small overall. They have an outsized impact in certain markets. I think there are fears that institutional investors drive up rents in the market where they have an outsized impact. But it's very important to realize that the institutional investors choose markets where rents are rising because there's a more severe housing supply shortage, where there's a lot of in-migration, where there have been heavy employment gains, and housing construction hasn't caught up. So it's so in fact, there's been some research by CoreLogic that actually shows that that rental increases come before the institutional investors. That is, rental increases lead the presence of the institutional investors in the market. That they're basically reacting and coming into those areas where home price appreciation and rental increases are more robust. That is, you definitely see the correlation, but correlation is not causation.
Here's one again from online. Are there any leading indicators to tell us what may be happening to home prices in the future? Any reliable ones?
I'll offer some opinions here. It's not as easy a question as it sounds, right? I think we really need to decompose the housing market into the supply and demand drivers. That's certainly how we look at the market. And so it's looking at leading indicators for both that demand and the supply side, right? So on the demand side, we've talked about some of the demographics, the household formations, right? There's a lot of debate in terms of where those are actually headed, right? We talked about the market not being in equilibrium, but that doesn't mean the market isn't clearing. The market is clearing largely through demand destruction these days, right? Households are just not being formed. Children living with their parents a longer time or living with roommates, what have you. And so then the question is, well, as we're looking ahead, what is that a temporary trend, or how much of that housing arrangement actually gets fossilized, and suddenly, these household formations that we thought were coming may not appear. So that I would argue there we need to look at those types of factors first to understand where that demand may be coming from. Second home demand, or the demand that comes from homes that are lost to natural disasters or to age, right? So looking at all of those factors certainly helps us to understand where things may be headed. And certainly the most recent hurricanes now have to enter into our analysis of these local markets. And then on the supply side, where's that construction coming from? What do those construction trends look like? What could policy or incentives do to change the trajectory of single family or multifamily homes? Where specifically are those homes being built, right? Again, of course, the regional impacts matter. So I would say all of those factors certainly are things we want to look at. But then, of course, more broadly, we have to think about the economy. And we're looking at leading indicators of economic growth, economic potential. So looking at factors that will drive the labor market, factors that will drive increased growth into the future, right? So always keeping an eye on some of those broader leading economic indicators as well.
So running out of time here, I think if there had been time, I'd probably want to pose one more question. And that is, there's been some talk from our presidential candidates about housing policy and the reasons why house prices have been under upward pressure and what to do about it. Unfortunately, I don't think we're going to have time for that one, and that might be one where we could spend 20 minutes on. So maybe there'll be a future panel to address questions like that. But all I think that's left to do is for me to thank the panelists. I've had a blast organizing this and hosting it, and really hearing your answers to these questions. Clearly, we got the right experts for this panel, and you've been very generous with your time to the Columbia students and to the Enterprise Risk Management Program. And I thank you very much.